Buenas tardes y bienvenidos una vez más a Casting Strategies. Hoy tenemos uno de esos episodios en lo que espero hablar muy poco y escuchar muchísimo para aprender todo lo que pueda de nuestro invitado. Tavi Costa es Chief Portfolio Manager de Crescat Capital, un hedge fund con base en Denver y uno de esos grandes hedge funds americanos que están quizá muy desconocidos para el inversor europeo, pero que están haciendo un trabajo absolutamente espectacular. Para ponernos en situación, Crescat Capital tiene 3 fondos, un Global Macro que lleva una rentabilidad desde 2006 de un 11,3 frente al S&P 500 en un 8,5, un long short que lleva una rentabilidad desde el año 2000 del 6,7 frente a un 5,7 del S&P 500 y un large cap que lleva una rentabilidad del 10,5 desde 1999 frente a un 6,7 del S&P 500. Resumiendo, batiendo al S&P 500 en todas las estrategias y en todos los periodos temporales. Algo que es espectacular y para que veamos el poder de generar beneficios de Crescat Capital, pues en 2018 hicieron un más 40 con su fondo Global Macro, cuando todos los grandes fondos de inversión en acciones pues estaban perdiendo alrededor de un 20%. Hello, Tavi. Thank you for being with us. It's a great pleasure to be here, to have the opportunity to make this interview with you. And the first question that I'm gonna ask you is how Tavi Costa arrives to the investment world and then to Crescat Capital to make the great job that you are doing today.
Well, sure thing. First of all, thanks for the introduction and for having me. I appreciate for the interview. Well, my story is probably very different than a lot of people in the industry. I originally moved to the U.S. to play tennis in college. So I was recruited to play tennis at a Division I school at Liberty University in Virginia. And then moved moving to the West as I lived here throughout the years in the U.S. And I moved to Missouri, then Denver. I started working with Kevin about 6 years ago. We've always been Kevin has always had a very value investing approach here, used a value investing approach throughout the years, and I've been kind of more involved on the macro side of things. I think that's really where we started to overlay a lot more of the macro thematic investment ideas in general to really start capitalizing on things that we thought were the most compelling ideas out there. So I would say that's more of how I got into the picture. Kevin has done a tremendous job, building models and quant models that we rank companies and the entire world, the most liquid companies, and just seeing what are the best opportunities out there, even if it is within an industry or a sector or just a theme itself on the macro perspective of things. And now the way I started developing more models in the macro side, so a lot of the macro models that we build here, which is mostly the proprietary models that we build, are the ones that I've been more involved in creating, especially your China theme and our precious metals theme, and the third one, which is or shorts in the U.S. As we think the U.S. is probably going to hit a wall here soon, economically speaking. And probably going to have a recession in the bear market. So it's a job where we are constantly looking for refreshing our portfolio and looking for the best ideas to express those themes. And I think obviously I have to attribute a lot of the performance you alluded to initially to Kevin as done an incredible job as a portfolio manager of Crescat, and I've been just the helper in the last years, and I hope I've been doing a good job at this. But it's been a great journey, and I look forward to the following years. And hopefully, we've never been so excited about our themes. I think there's a lot of opportunities, especially in those three high conviction ideas that we're mostly trying to capitalize. And I would love to elaborate on those if you guys would like to.
Of course, we would like. But first, Tavi, I'd like to ask you a question, because you manage this kind of quantitative models for, driven especially by value investing. This is in regard to stocks, but how do you manage quantitative models in macro side of things? I mean, I know how to manage, how to get involved in this kind of quant fundamentals approaches. So I can look for value, I can look for growth, I can look for many things. But when it comes to macro analysis, I've always been a sucker for macro analysis, but I'm not that good. So would you mind to elaborate a little the way you do it?
Sure. I think the important part is to look back in history and look for indicators that have worked very well and predicted recessions or turning points in the business cycle in general, not just recessions, sometimes bull markets as well, not sometimes, a lot of times. So I think that's been most of the focus is searching for those indicators that have a high correlation to the changes in the business cycle. And idea initially was, okay, we're seeing a lot of issues in the markets here in the US and China as well. How can we give a score to the business model today and see, when that compares to historically? So that was really the idea, combining indicators and then overlaying that with the value approach by looking at, the valuation of companies in general, regardless if it's public companies, private companies, housing market, and so forth. So, so you're ranking all those indicators and aggregating them to a one final score that tells you where are we today, and then you search for, using the quant model on the value side. This is at least the approach that we use, is to search for, let's say, if we're short in the industry, we're looking for, what are the most expensive companies out there that could provide alpha in a way, if that theme turns out to unfold the way we think it will. So I think that's most of it. There's a lot of macro models that I build personally, and a few we put out there with we publish a lot of them on social media. Not macro models, but indicators that I find it interesting that I look for. But correlations change throughout history, and that's the problem as well. You never know which indicator is going to coincide or proceed to a recession and tell you really what you should be looking for in the following months or years. Now, I think that there's an interesting point to be made here, that when you can combine a lot of them together, perhaps you have an edge on really figuring out those turning points. And I think those turning points, from what I learned with Kevin as well, is really where you can make really profit from those investment ideas. So I think that would be most of it, and just trying to think outside of the box. It was really very focused on creating your own thoughts about things rather than reading a lot of other people's opinions, and then by aggregating data and doing your own research. I mean, you can find a lot of things that and a lot of takes from that is very different from what's out there, and I think that it creates a lot of value for figuring out a lot of ideas that not a lot of people are focusing on. That we end up being sometimes, very early on figuring them out. So I don't know. I think Kevin has done a good job, especially if you look back in housing bubble, how he was able to really calculate the imbalances at the time. And so I use a lot of his approach back then and try to, use that today. Now, recessions, I think a huge mistake today is that people look back in 2008 and 2000 and think that the next recession, if you will play out very similar to how it played in the last two recessions. What we try to do is to look back, 70s, 60s, 30s, perhaps 100 years, and really see what it really looks like today, and if there are any similarities to back in the days with those imbalances that really turn out to be recessionary events. So I think that's really the key point is to really look at. almost everything aggregated and figuring out what's the score. Give me a score of today's business cycle. And then in our view, the business cycle is really late. We're at very late stages today. And at the same time, you have, companies that have really almost record valuations in any factor or fundamental factor you look at. So that's kind of an interesting idea. We're definitely focusing on hopefully profiting from those ideas today.
Well, you have done.
In this, it's quite strange for Spanish investors to understand value and macro going together. This is quite strange, but it's also strange when you see how do you create these macro ideas and you place them into themes like yuan devaluation, maturing expansion, reefer madness, these kind of themes inside the macro global ideas that you are looking for, and you separate and you give them points and possibilities of making profits or not. How do you do that? And how do you go finally to these themes as the way of looking for opportunities to invest in your day-by-day work?
Sure. I'll use an example of the U.S., for instance. I think that's maybe a good approach. Here in the U.S., we saw, in a broad way that markets are really overvalued and a lot of factors that we look at. And then from there, we wanted to see, is the economy turning, is our macro indicators in the U.S. really deteriorating recently? And one factor that we found that was not deteriorating at the time, which was really against our view, was that the 2 versus 10 spread, so the 2 yield versus a 10 yield spread, was not inverted at the time. That was kind of a big deal because it is, it is something, an indicator that does turn negative prior to a lot of recessions or coinciding to a lot of recessions. So that kind of drove us to look at the entire treasury curve and look at, what are, all the possible spreads in the yield curve. That really was when we built the percentage of yield curve inversions in the US, and we figured out that was about 70% of yield curve was inverted. Now, when you look at that throughout history, every time we reached that level of 70%, we had a recession follow. So that was sort of a big deal. Well, from there, we wanted to understand what are the companies or what are the ways of really investing in periods of when you reach that level of inversions in the credit markets. Well, one of them was buying gold and selling stocks. That seems to be the most compelling idea, the best investment that outperformed tremendously during those periods. Depending on the time, that ratio itself, if you're long that ratio, you probably perform 150% or so of returns in a 2-year horizon or so. So that was, quite interesting way of playing that. But how can we really take advantage of that instead of just being, kind of a plain vanilla, being long gold and short stocks? Well, then we used our models to really figure out what are the industries that look more overvalued. So that's really when we search for, software stocks, for instance. When you look at software stocks and a lot of the IPO bust stories that you have today, a lot of those are trading at like 30, 50 times revenues. I mean, this is kind of like 2000 euphoria type of valuations. And I think that was kind of a telling for us. And that's when we started to kind of move towards that direction and really search for, in our model, what are when you start looking for the model and you start seeing a lot of those expensive, the worst scoring companies in our model were, utility stocks and perhaps, a lot of the software stocks. And you start looking a little deeper on the industry itself, you see that there's an entire theme behind that, or I should say a sub theme, right? That kind of fits into those high conviction ideas, those 3 high conviction ideas. And that's really when you start building those kind of sub themes. And that's kind of how we look at risk as well, because we bucket or risk by looking at those sub themes, and no other theme can have a certain amount of risk. And so we limit ourselves into those sub themes and also on an overall basis too. So that's kind of how we look at the portfolio construction part of it, and how we end up building, all this themes, regardless if it is on the cannabis side or software stocks or utility stocks. But they're all, if you really think about it, I mean, value and macro are really very similar in a way. I mean, the macro side. I mean, if you look at, let's say, commodities like silver and gold, it's almost like a value macro asset that is really cheap today. They offer a tremendous value for investors today. And macro side, in terms of having a tremendous safe haven aspect to it, I think that's all part of the picture of picking the most compelling ideas out there. I hope I'm answering your question, but this is the way we see it on how to build themes and sub themes. So it starts from looking for the largest imbalances and inconsistencies out there, and hopefully those are historical, because those are the ones that, when you have the turning points, are the ones that tend to be more profitable. And then from there, we search for those sub theme ideas that become a huge part of how to express our views. That's really the way to do it. The China example is another one. So the China credit bubble is really, when we start seeing, globally, you have all this record leverage globally, and that's not like a new theme. I mean, we've had that for a couple of years. But what is really driving all this debt imbalance? And one of major, I guess, contributor to that has been China. And when you start looking at China, and you can kind of break down, you start seeing that there's issues in Australia, there's issues in Canada, there are issues in Hong Kong. Those are imbalances that actually can play out in a knockoff effect of those credit crises that you can really benefit a portfolio if you're, let's say, short banks, Canadian banks, or so forth. So that's really how we kind of end up developing those themes. It starts from the top down approach, and then we end up building those kind of sub themes at the end of it.
Yeah, I love that, because it's super interesting about blending both ideas, macro, and then to get into the construction of the portfolio. So I love it. I got a question, Tavi, also, that is, nowadays, what you have now in your portfolios, if I'm not wrong, is precisely what you were talking about. I mean, gold, long, and you are shorting stocks in the US, if I'm not wrong either. And you are touching also kind of options also, managing options in your portfolio. I think those are the main ideas that you are, the main assets that you are using nowadays. So I'd like a little bit more to elaborate, if you could elaborate a little, what you have today in your portfolio and why you have it today.
Sure. So yeah, there are definitely derivatives in our portfolio that we manage with a lot of options. It's not a huge amount, but those are the ones that we see most asymmetric opportunity. One example being the Hong Kong dollar DPAG. In things like gold, for instance, the precious metal side. I mean, we see so much value in mining stocks. There's some mining stocks that have this opportunity of returns, that we think that if there is really a bull market, if we are in the early stages of bull market for precious metals in general, those companies can go up 300, 400%. That's almost like an option on its own. So we like those companies because they have been in a depressed market for a long time. So precious metals is a very interesting sector or part of the portfolio in general, because I feel like it's very mispriced in a lot of ways. You had this decade high for core CPI and median CPI, which it's crazy, because at the same time you have inflation expectations being at record lows. So on the option side of things, if you can find something that provides you that asymmetry, I think that's all interesting. Now, so we find those three high conviction themes, being China, being there's the currency devaluation on China that we think it's on the way. We think that there's a possibility, the odds for you to short things like the Hong Kong dollar, DPAG. It's kind of an interesting idea, and also it's very cheap. You don't have to risk a lot of your portfolio on a premium side for derivatives, because the implied volatility for those options is so low. So I would say that those are kind of the asymmetry ideas on the currency side. There's just more on the value part of it. When you look at the models or quant models to look at banks like Canadian banks and Australian banks, they score terrible in our models, especially among financials. And they look a lot like, if you look back in history, look a lot like the 2006, 2007 U.S. banks. And we like those things because it kind of offers you a great opportunity if there is really a downside here in the markets. I think those are the things that are going to fall the most. And they're very much involved with the China credit bubble in our view. So we don't have options in those places today. We've had it before, but it all depends on what's the best way of expressing those ideas, and can we fit in the portfolio in a CVAR basis. We look at CVAR models to see if we can fit there in terms of risk. We don't want to have a really high daily volatility in the funds. So we try to keep that, somewhat constrained in terms of that. There's a lot of great bets like the Hong Kong dollar. There's not a lot of volatility on a daily basis on that bet. If you're losing money on that, it's not like a huge volatility because the premium's so low either. So, there's a lot of interesting ways of putting in your portfolio or constructing your portfolio today that I think that we've been kind of taking advantage of those, hopefully. I think there's a lot, if you look at the macro trade of the century that we put out maybe a few months ago, which we truly believe that it's going to play out, is, it's not just being long gold and selling your stocks, but it's being long gold in renminbi terms. In other words, in Chinese currency terms. And it's interesting because when you look back in history and you look at emerging market currencies, when there's a crash of emerging markets, you never know. And sometimes, like you had in Brazil in 90s, the currency devalued tremendously, but at the same time, stocks actually went up in local currency terms. So what's the best way to play it? Well, the best way to play in our view is if you buy gold in local currency terms. So emerging markets when they crash, the gold in local currency terms tends to rise. So, if you can, so that's our way to see it. We look at gold in renminbi terms relative to MSCI World, which is a global stocks. Why? Because we're short a lot of American companies, but we're also short some Canadian and Australian banks as well. So, it's kind of how we're positioned today. We think there's, if there is really a bear market on the corner here, I think there's a lot of opportunity on the upside for us. And we've had those situations on days. Watch those days that you had, issues with, trade agreements with Trump and China, for instance, or Xi Jinping. But what do you think works in those days? Well, exactly. That trade works perfectly in those days. And I honestly think that that's only going to get worse. I think there's no way they're going to reach a trade agreement. I think the credit imbalances in China, there's no way they're going to get any better anytime soon. I think that the issues in the U.S., there's not much upside in my view in terms of the U.S. What is the juice of really going after, a little extra spot here of returns in terms of, betting on, the valuations going from historical highs to a little bit more historical highs? That's not really what we're going for here. Just if you have a mean reversion move of valuations here, of going back to like the, literally the median of valuations, we're talking about 50% drawdown in value of stocks today. This is a huge risk that I don't think a lot of investors believe is about those risks. And we see that as a huge opportunity. I think this is a very exciting time to be invested, and we're really looking forward for the next 2 years or so, because I think that yield curve inversion research that we did, and looking as being long precious metals has earned a perfect setup today, right? I mean, you have the Fed already printing money, you have the Fed already cut rates, Fed print already $300 billion of added $300 billion to its balance sheet. If it was QE or not, I don't really care. They added $300 billion. That's dilution of their currency. And that's not even to mention central banks already printing money globally for a while. So I think this sort of dependency on central banks that they're going to be able to prevent the next downturn in the cycle, it's ludicrous. And I think it's not going to happen. I think business cycles exist, and we're going to have a downturn. And I think that there's for a global macro fund, for the global macro funds out there, this is a huge opportunity. And, I think, we're very much focused on profiting from that downturn, and hopefully that's going to play out.
It's amazing to listen how open is your way to understand the investment, and how open is the approach, in the approach that you make to take advantage of the situations, the ideas that you have about what is happening in the world, you know? That is, well, some situation is happening, and it's not only buying gold and shorting stocks, but in local currencies, but doing this, but through options, but you know, it's amazing to listen how wide is your, and how open is your way to understand how to invest in every single situation that you are facing. And because, you know, here in Spain, most of the people are investing through mutual funds, and mutual funds, they are not able to do not what you are saying, but not 10% of the things that you are saying, no? They are not available to do this kind of investment. So it's amazing. Okay, but going to this possibility of investment and the things that the people is worried about, you are saying one thing that I was going to ask you, and it's about the Federal Reserve printing money again. They are not saying that it's a QE, but there is. BCE is doing the same. Do you think really that the recession in the United States is close? Because it's something that maybe we don't see so clear, or is not so clear there, because then you see the jobs growing, you know, the labor day by day growing. So what is going to happen, and how this is going to affect the stocks in the United States? How do you see this is going to affect the stocks in the United States?
Sure. I think that the liquidity is the major factor here. And when liquidity shuts down, it's when the party is over. I think that there's a lot of ways to look at that. You know, major one has been U.S. share buybacks, right? And we've had share buybacks. It's really been the thing of this last rally in the markets. And when you looked at CEOs and CFO confidence plunging in a way, and at the same time you have this long list of CEOs and other important positions in companies now resigning. And this is very telling. You got insiders selling a significant amount of stocks as well. Those are all parts of liquidity that I think are important. The second part of it that I think is huge is the cost of capital. While cost of capital has been so cheap, and it's been a major reason why we haven't had inflation so far, I think that a lot of people look at the technological changes since the global financial crisis as a very positive deflationary thing. And I agree with that, but I actually believe that the cheap money, the cheap credit was actually what drove the deflationary levels that we are today, or that we had today. You would expect that a lot of money printing would have brought inflation a lot higher, but it didn't, because the cheap money actually was able to enable those companies to money-losing companies to survive for so many years. You got Uber, you got Lyft, you got WeWork, and all those companies are able to provide, Beyond Meat, they're able to provide very cheap services and goods, on the cost of losing money literally every quarter, because credit is cheap. They're able to just raise money in a very cheap way. Now, we're having this, you can call it a WeWork effect, right? Recently, we had this issue with SoftBank and so forth, which investors are now kind of looking forward and trying to see if there is a path to profitability in those business models. And when you start seeing that kind of change in mindset, that's a huge problem for cost of capital. Why? Because investors are really looking for how are those guys going to make money. And when you looked at the possibilities of those guys making money, there isn't really a possibility. Either they're going to have to cut labor market, right? Which is exactly what you've seen in a WeWork situation, or they're going to have to raise costs of their services and goods, which is kind of what you've seen in Netflix, for instance. Netflix has been a business that only lost money for the last decade. I mean, it's been just terrible. And I don't think Netflix would probably exist in a high cost of capital environment like the 60s and 70s. So that's kind of interesting way to look at. And if you do have that increasing, well, what is that? That is really inflationary if you think about it, because that means cost of goods and services have been depressed because of cheap money and credit. So I think that's about to change. It's changing slowly. You can see the IPO bust ideas. You can see leveraged loans is starting to drop significantly. So there's a lot of pockets of the market they're already starting to fall apart. Cost of capital is a huge part of the liquidity issue that we haven't had it yet. Now you're having also the repo market. Repo market is another one. I mean, it's kind of coincidental that we're seeing that again, another time late in the cycle with record valuations. What's going on? Nobody really knows what's going on, but it's certainly kind of, a very weird situation, if you will, in terms of banking industry in general. So, I think it's hard to say when exactly the recession is going to come or the bear market. Do we have the perfect setup already? Yes, we do. Now, the best way to approach that, in our view, is to really have, I think, in terms of that, how mispriced inflation is, how central banks are reacting. And I think central banks are reacting that way because they print money in the past. And guess what will happen? Nothing. There has been no cost for printing money. I mean, all it did, you can call it a cost that created bubbles, and I completely agree with that, but that's not what I'm referring to. I'm referring to cost of capital. If you're massively diluting your currency and you haven't had inflation, essentially tells you that you can print money, you have no cost. That's what they're thinking. And that's why monetary policy have got more and more aggressive throughout the years and throughout the cycles. I think that, they're going to continue to do that, thinking there is no cost in the near term. And guess what? At the same time that you're having those issues of monetary dilution, which I think it's going to come at a cost this time. I think that's the key part of it. I think money printing, rate cuts, and all these interventions are going to come at a cost. And I think that's going to benefit, areas like the precious metals, why we're so bullish on precious metals. And also at the same time, there's a good paper on the BIS a few years ago. I think 2017, they wrote a paper on globalization being a huge factor for this kind of a deflationary force, which, it kind of makes sense today. Now you having this sort of deglobalized kind of force on the horizon here from China, US, and even the US versus Europe, or US versus Mexico, and US versus Brazil. And this is kind of interesting because at the same time, when you look at commodities, for instance, which is a major reason for inflation in the past, right? Commodities have always, when you have supply disruptions of oil, or let's say just like pork prices that's happening in China today, when you have those issues, that's really where it drives inflation rates higher all of a sudden. We haven't had that in a while. I mean, if you looked at the commodities, just chart all commodities for the last 10 years. A lot of them are down 30%, 40%. We haven't had any, price appreciation in commodities in a long time. So, I'm just looking at that and I'm seeing, well, there's a huge opportunity here for precious metal side on the loan side. And then at the same time, you have this, sort of crazy valuations with liquidity kind of reaching a limit here with, equity markets, private equity markets too, at extremes. So, with all this macro indicators deteriorating, in a major one being yield curve inversions, a percentage of yield curve inversions already reach a 70% level. So I really think that this is, it's a very, very interesting time to be as an investor, no doubt.
Absolutely.
Well, it's listening to you, Tavi, it's really kind of jaw-dropping, I love it. I got a last question. Yes, if the market is to crash some way or another, and you are so bearish, could you put up some examples about shorts, stocks that you have shorted now?
Yeah, well, I unfortunately can't talk about individual names, but the industries that we've been focused on has been a lot on most of the really the worst scoring companies in our model, and I'll elaborate more on that. Software stocks are one of them. The FANG stocks are a key one. You look at Amazon, for instance. or Netflix. I mean, a lot of people say, well, Netflix, it makes sense because Disney's coming in. Folks, I mean, Disney has been coming in for the last 2 to 3 years. This is not a new thing. Everyone that follows Netflix knew that.
Yeah.
This is a change in investors' mindset. It's a company that is a great example of a company that's been raising capital through debt and equity issuance and making no money on a story that, they're creating a network effect. This is a platform that's going to be profitable, and it never turns into a profitable business.
Yeah.
And, it delays for so much time that at a point where investors say, well, enough is enough. And you start selling that. So, we're focusing a lot of the FANG stocks. Obviously, Google is, and even Facebook a little bit of an exception there, as they have been very profitable. Now, Amazon also has been a great story for the market. And look at Amazon's probably the most successful story of the last 20 years or so.
Yeah.
I mean, look at the chart on Amazon. It broke down from a significant support line. I think it was a 5-year support line. And it's now, it hasn't gone above it. It's completely neglecting this upward move in S&P 500. I mean, what is that telling you? This is the most successful story. This is the market darling stock that nobody is now believing in it anymore. So, you look at, a lot of the micro cap stocks are also down significantly. And so, those are all parts of the market that we've been focusing on. The FANG stocks, the software stocks. Utilities is an interesting one because a lot of people perceive them as defensive plays, and I completely disagree with that. Not in the sense of being, they have played as defensive or proxy for fixed income, if you will. However, what you see today is that they're historically leveraged. They're historical valuations. And at a time when, I think, again, it's been another one that benefited a lot from this cheap credit and cheap money in general. And I think that if that's changing, if there is one industry or sector that will not benefit from that, is going to be the utilities sector in general. So, if you have right now, we're kind of seeing, this move up on yields. We had a sort of a long position on treasuries a while ago. We switched that to a short position a few months ago because we saw the rate of change of 10-year yields going, extremely negative. It dropped tremendously. I mean, historical, I think, was the largest rate of change of 10-year yields ever. And we saw that. We're like, well, this cannot, be sustainable. So at the same time, you have all this kind of inflationary signs that we're seeing that we thought was like, well, this is a kind of an interesting bet that rate's going to go higher. Well, guess what could sell off significantly if we do have an environment like that? Well, that's utilities. Utilities, when you have that, that's kind of your beta play on treasury selling off is utilities. So, when you look back in history, like the 1930s, for instance, when you had the Great Depression, well, utilities actually fell apart right along with the market, actually fell even worse in the market. It was terrible. If you're a utility investor at those times, you did terrible. So, I'm saying a lot about utility, but we have other sort of more cyclical kind of plays, if you will. Again, the software is a major one for us. Why software is a major one? Why? Because it's very cheap to short them. They don't pay dividends most of the times. The borrowing cost is very low. So it's, those are kind of interesting plays for us. In terms of financials, we don't have any plays in financials in the US. We have a lot of financials in Canada and Australia. We have some ADRs in Chinese ADRs. We have a lot in Hong Kong too, that we think are going to be, kind of get caught up in this political issue. When you think about political issues, you look back in history again, use that in your favor. I mean, every time you have a political problem, I know that, well, Brazil had just had a political problem in 2014, 2015. Yeah. Argentina just had one. There's always an issue. It either is the currency falls apart or you have an equity market that falls apart that starts with the economy that falls apart. So, it's kind of what we're seeing. The GDP numbers in Hong Kong are turning lower. You have deposits. Some banks are starting to decelerate. You have, loan losses provisions relative to revenues for banks. Hong Kong banks is now at the lowest level, even to levels like the Asian crisis, prior to Asian crisis. If there is, let's say if those loan losses are actually larger than what they're provisioning for, you know, back in the days when you have like the full-blown Asian crisis mode, those banks are provisioning close to 20 to 30% of their revenues. That completely kills their earnings. And today they're only doing like 1.7% of their revenues. So, you know, that's where the opportunity is really. I think that's, you know, when if there is and even today in the US, I mean, corporate earnings in the US overall, if you look at the Russell 3000, is actually contracting. If you looked at that, it's very hard today to find an investable asset that yields more than inflation rate today.
Yeah.
You know, I challenge anybody to find a good, you know, a quality investment that actually yields more than inflation rates in the US. Median inflation rate in the US, for anybody who doesn't know, it's close to 3%. It's a decade high. Why median? Well, median is probably, if you know, just look back and see a lot of the ways of measuring inflation is perhaps the best way to really calculate inflation rates. It's probably not perfect, but it is probably the best way. I like the median calculation a lot more than any other. Core CPI is also at a decade high too, and it's also, you know, just use the core CPI and you see it's very hard to find any investment that yields more than that. So what is it telling you? Precious metals, you know, precious metals is probably your best alternative in terms of that. You have $15+ trillion of negative yielding bonds, sovereign bonds out there. You know, it's another play for precious metals too. Anyways, I'm obviously talking my book here, but it's you know, I think
Well,
there's
it's awesome. It's awesome.
What's that?
No, it's awesome, man. It's
Okay.
awesome to listen to you. Yeah, sure.
So,
Sorry.
No,
Tavi,
it's perfect.
listening to you, I get the conclusion, and everyone has to get the conclusion that investment is not only to buy a stock or not buy it. That investment is not only have liquidity or be invested in the Nasdaq,
No.
as a lot of people think. Thank you very much for being here with us this afternoon. We encourage you to be with us again one day or another when the cycle is gone and we can talk about all the ideas that you were sharing with us today and see how they perform in all this, you know, the beginning of 2020. Thank you very much for having with us. Do you want to say something more?
Well, it was really interesting to listen to you, Tavi. You know, I was just thinking, you know, as I told you before, macro ideas for me I'm kind of a sucker for macro ideas, but I'm not that good. You know, it's quite complicated. And I love the way you blend those quantitative approaches with the way you pick stocks also at a time, developing those ideas of themes. So it's really interesting. You know, it was just a pleasure, and we want you to come again if you want. So it would be our pleasure.
Absolutely. It would be a pleasure. It was a pleasure to meet you guys and talk to you guys. I always enjoy discussing macro value investing. It's always a very fascinating topic in general. And again, I think this is a great time for investors to be in the markets, and you know, very different than what a lot of people think. I think there are a lot of opportunities out there, and I think one day we're going to look back and say, wow, this was an incredible setup for a lot of things. So hopefully we will be able to position and profit from those ideas, and I think that's our goal. But thank you so much for having me, and I look forward to, you know, other conversations.
I'm sure that you will profit all of this, and you have to know that I can't, but if I could, I would be an investor in your fund. Thank you very much for being with us today.
Thank you. I appreciate.
Okay. Muchas gracias por estar con nosotros en este vídeo. Si os ha gustado, podéis compartirlos en las redes sociales, podéis darle un like y nos vemos en próximos vídeos.